drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
What's up, guys? This is Manoj Tani. I welcome you all on behalf of the Edupedia world. It's a fantastic morning outside, and I'm sure that you guys must be enjoying your life, your environment, your family, each and everything, whatever you get into, to the fullest. Like as usual, guys. Perfect. So, the wait is finally over. We are through with the theoretical concepts in relation to the chapter of capital budgeting. Now, with this particular presentation and in the forthcoming presentation, all I'm gonna do is just discuss the kind of questions that have already been asked in CA final examination in the previous attempts, so that you can get a flair and a kind of idea how you should prepare yourself in order to compete in that examination. So, are you guys all set? Are you guys super energetic? Perfect, guys. Let's bring that enthusiasm into this presentation of yours, solely dedicated for all of you guys. So, I am pretty much sure that by now you guys must have revised all the kind of concepts that have already been shared with you guys, that have already made you understand in the previous presentation. So, you don't need to escape or skip any of those relevant topics. That is extremely crucial for you guys. If in case you have not revised your topics properly, to revise, that is something which is extremely important. Let's mark the beginning of this wonderful presentation. Fasten up your seatbelts. We're about to take off with the first question of the day, and that will be: Company Y is operating an elderly machine that is expected to produce a net cash inflow of rupees 40,000 in the coming year and 40,000 in next year. Current salvage value that we'll be able to receive if in case we'll be selling off that particular machine in this present year, year 1, that will be rupees 80,000. And the next year's value, if in case we don't go in for and we don't sell out that machine in the current year, and probably we'll be selling that machine in the next year, we'll get the next year's value as rupees 70,000. The machine can be replaced now with the new machine, which will cost us rupees 1,50,000. Is much more efficient, that machine, and it is going to provide us a cash inflow of rupees 80,000 a year for the next 3 years. Company Y wants to know whether it should replace the equipment now or they should wait for a year with a clear understanding that the new machine is the best of the available alternatives and that it in turn be replaced at optimal point of time. We can simply ignore the taxes that has been stated in the question as well, and we need to take an opportunity cost of capital as 10%. Advice with reasons. So guys, let's understand this question first of all before moving on to the solution part. Okay, I need to ensure that you guys develop an understanding how to go about and take care of the examination question, because in order to write it properly, you need to first understand and how we should present it in such a manner that not even a single mark gets deducted from our answer. Okay, so this question is basically a very simple one. Okay, what it's saying is that my old machine is probably gonna give me a cash inflow of 40,000 rupees this year and 40,000 next year. That's simple. If in case, let's suppose I feel like that I need to change my machine, okay, I need to replace my machine with a new one, okay, then I'll be selling my old machine now itself in this particular year. Then what amount will be I'm getting from that? I'll be getting 80,000 rupees if in case I am willing to sell that machine in the current year itself. If in case I'll be delaying my decision of selling that machine to the next year, I'll get a salvage value of rupees 70,000 next year. Cool? Perfect. Number 3, my new machine is gonna cost me up 1,50,000. Okay. Be it if in case I purchase it now or if in case I purchase it next year, it's gonna cost me the same amount. That is 1,50,000. What benefit it's gonna provide me? The benefit is my incremental cash flow will be of rupees 40,000. Why? Because if in case I would have resorted to my old machine, it would have provided me a cash inflow of 40,000. Now with the bringing of that new machine into the business, I'll get a cash inflow of 80,000 rupees a year for the next 3 years. Okay, so my incremental cash flow will be 40,000, 80,000 minus 40,000. Number 3, cool. Next, Now I need to decide, okay, whether I should replace my machine now or in the next year. Okay. The opportunity cost of capital that has been told to me is 10%. Why opportunity cost of capital has been like provided in the question? Think about it. That's simple, guys. If in case I'll be accepting a new machine, okay, I'll be replacing the new machine next year. I'll be definitely going for that opportunity cost of capital that I'll be like, I will go with that opportunity cost. Why? Because I didn't resorted to the replacement of the new machine in the current year. So I'll be losing some amount of cash inflow. That 80,000 minus 40,000, that 40,000, I'll be actually losing out on that opportunity cost of 40,000 rupees. So in order to get that opportunity cost of 10%, this particular percentage has been provided to us. I hope you got the complete understanding and the framing of the question. Now let's proceed towards how we should perform in the examination question with a proper presentation. And that will be this. It's very simple, very simple, guys. We need to decide whether we should replace the machine either now or after a year. I have been told that the initial investment that I'm gonna make on that new machine, it will be rupees 1,50,000. So if in case I want to get the costing, the minimum costing, I will simply deduct by 1,50,000, and out of the same, I'll be adding what benefit I'll be getting out of it. I'll be getting 80,000 rupees each year for next 3 years. My opportunity cost of capital, that KE that has been provided to us, is 10%. Okay, so what will be my present value index factor annuity in that particular case? That will be 2.487. Okay, so 1,50,000 minus that 80,000 into 2.487, I'll get a figure of rupees 48,960. So what all costed me in that particular case? While spending 1,50,000, I was able to get back 48,960 rupees more in that stuff. So I'm on a benefit side. Perfect. Now I'll be dividing the same with my present value index factor annuity. Okay, well, which will be 2.487. So I'll get what should be my equated annual benefit. Okay, for each year. This 48,960 is for 3 years. Okay, and not even for 3 years, basically it's less than 3 years if I'll talk about the time value of money. So time value money would be 2 years and 487 months accordingly. Okay, so that will be like divided from that. I'll get the equated annual benefit in that particular is what will be my benefit in each year, that is 19,686. Now the thing is, if in case I replace the machine now here at this particular point, that is year 1, immediately I'll get rupees 80,000 and an inflow of rupees 19,686 each year. Okay, how did I got immediately 80,000? Okay, why? Because my salvage value was 80,000 rupees. Okay, so I'll be getting immediately 80,000 and an inflow of 19,686 rupees each year. Now that is one situation. Number two situation could be, if in case I resort to the next year selling. Okay, what will happen if replace next year? I'll be losing on this 80,000 rupees, which is my opportunity cost for now. Okay, so what will be the amount future value of this 80,000 next year? So that will be inclusive of interest loss, that will be 1.1%. Okay, so I'm gonna lose on 88,000 rupees if I'll talk about something in relevance of next year. Okay, I need to add my opportunity cost on that. Next year's receipt will be 70,000, which has been like shared in the question itself. I'll be getting a price of 70,000. So what am I losing if I'll talk about just the salvage value part? I am losing onto an opportunity cost of 18,000 rupees. Okay, that is my implied loss. 10,000 for now and 8,000 is the time value factor. Okay, however, we still note this fact that we have got rupees 40,000 as inflow in the year 1. Okay, why, guys? Because the old machines cash inflow was 40,000 and 40,000. Remember? Perfect. So we will still get 40,000 even after losing 18,000 for the first year. I'll be getting an amount of 40,000 in the first year, that is for sure. Okay, I won't be considering the next year's cash flow with the new machine. Okay, because I haven't purchased the new machine yet. So all I'm considering is that I'll be getting an inflow while using the old machine, that is rupees 40,000, and I'll be having an implied loss of 18,000. So by the end of that year, I'll be having 22,000 in my hand plus rupees 19,686 for the next after thereafter years. Why? Because the same thing which is going to happen in this year, that 15,000 part, it's going to be the same for the next years as well. I need to spend that 1,50,000 as initial investment, and for the next 3 years I'll be getting 80,000 rupees, that's for sure. So my equated annual benefit for the next 3 years, okay, after year one, will be remaining the same actually. So what I'm getting from this particular stuff is, if even if I don't go for or even if I don't resort to replace the the old machine, the new machine in the year one itself, still I'm getting something out of it. Okay, so I'm getting 22,000 in the year one, and I'm also getting 19,686 rupees for the next 3 years. Okay, so what is the analysis? If I'll talk about what's the conclusion, the equivalent annual cash flow of the proposal to replace the elderly machine with new machine after 1 year is higher. Okay, so what's the benefit? Absolutely go ahead with the replacement after 1 year, not now, because you'll be losing onto an opportunity cost of 22,000 that is available over here, okay, in the year one. So the decision stands confirmed. You need to go with the replacement after a year and not now. Am I clear with this particular stuff? I hope I was able to showcase you the kind of presentation that you should go ahead with the same, and that will ensure that you guys don't get stuck with any of the like mismatch of even a single mark. Okay, and you'll be getting optimum 6 by 6 or maybe like 4 by 4 in that particular question itself. So, are you guys clear with that? Perfect. Let's move ahead with the next question. So again, this question has been like asked in CA final examination, and it says AN company is contemplating whether to replace an existing machine or to spend some money on overhauling it. AN company currently pays no taxes at all. The replacement machine will cost them rupees 90,000 now, and it will require an annual maintenance of rupees 10,000 at the end of every year, okay, for 8 years. At the end of 8 years, it would have a salvage value of 20,000 rupees and would be sold. The existing machine requires increasing amounts of maintenance each year. That old machine is basically like asking for more of the maintenance amounts, and its salvage value is falling each year. So the year one, if I'll talk about the present scenario, the maintenance is zero for the old machine. The salvage value is 40,000. If I'll talk about year one, after a year, that maintenance cost is gonna be like increasing for rupees 10,000, and the salvage value will be like decreasing to 25,000. For year two, that's gonna be 20,000 and 15,000. Year three, 30,000 and 10,000. And finally, for the fourth year, maintenance gonna be 40,000 rupees, and the salvage value will be like zero. Okay, altogether turnaround case as far as that comparison with the present case is done. The opportunity cost of capital for AN company is 15%. We are required that when should the company replace the machine. Okay, the annuity factors have already been provided in the question itself. So for the next 8 years, if I'll talk about present value annuity at a percentage of 15, that will be 4.4873, and for the last year, that is 8th year, it's gonna be 0.3269. Okay, now that's this particular question is like 80%, or I say like 70% on the same lines as to like previous question itself. Okay, however, this question has been like asked twice in two different alternative methods, so I wanted to incorporate this question as well in order to ensure that maybe there is a chance that you will get the same kind of question in your examination time as well. So what you need to understand in this particular question, guys, is that the replacement costing, if I'll talk about the new machine cost, that will cost me 90,000 rupees. Okay, and I need to provide for the maintenance of rupees 10,000 each year for the next 8 years. Okay, that is something which is static in this particular case. Now, after a period of 8 years, my new machine will be like having a salvage value of rupees 20,000, and it will be sold, done, sorted. Now, if I need to make a comparison of the same with the new machine with my old machine, okay, the kind of maintenance cost is like increasing day by day. Okay, and it's like increasing year by year accordingly, and the salvage value is decreasing altogether. All we need to analyze here is when should we basically sell out the old machine and replace the same with the new one. Okay, let's understand that with the kind of framing and how we should proceed while solving this particular question in the examination. Let's go ahead with the same. Now, we all know that the present value of the new machine is gonna be rupees 90,000. Okay, I'll be getting here, if you can see, my new machine is gonna be costing me rupees 90,000. Okay, apart from that, I need to incur some of the maintenance costs each year, that is rupees 10,000 for the next 8 years at the present value interest annuity factor of 15%. Okay, however, at the end of 8th year, I'll be getting a salvage value that is 20,000, which is shown here. I'll be multiplying the same with the present value index factor of 8th year, that was 0.3279. Okay, I'll be getting the figure that is what is my present value of the new machine. I have to incur right here, right itself, 90,000 rupees, plus I'll be incurring 44,873 rupees on its maintenance. Okay, out of the same, I'll be deducting what I would be getting after a period of 8 years. That will be 6,538 rupees if I'll talk about its present value. So what amount did I spend it in that particular case? With the overall 8 years, I spend an amount of 1,28,335 rupees for procuring that new machine. That is my present value of it. Okay. Now, what's going to be done from my end? Again, I need to take the equated annual cost of new machine into the picture. Okay, so if I'll be dividing this 1,28,335 rupees from the present value interest rate factor annuity of at a rate of 15% for the next 8 years, I'll get that I need to incur a amount of equated annual amount of rupees 28,600 rupees each year in order to procure that machine. Okay, that is my costing if I'll talk about. Now, what's my conclusion if in case I talk about? My conclusion would be, if in case I replace the machine now, here itself, I will get 40,000 rupees now. Okay, because I'll be like selling off that machine. So I am getting a salvage value of rupees 40,000 now, and my maintenance cost was zero, remember, in the present case. And I need to spend rupees 28,600 for the next 8 years thereafter. Sorted. Replace now, get 40,000 and spend 28,600 for the next 8 years. Done. Now, coming on to the second part. Let's suppose if we replace the machine after a year, what's going to happen? I'll be losing on an opportunity of 40,000 rupees. Okay, that salvage value I won't be able to recover 40,000 rupees. However, at the end of second year, I'll be able to recover 25,000 rupees. Okay, that has been like provided me into the question itself. So I won't go for an option of 40,000. I may have an option of going ahead with 25,000 if in case I want to replace the machine after a year. Okay, and we need to spend another 10,000 rupees on maintenance. In the first year, there was no maintenance cost as far as the old machine was concerned. But in the second year, if I'll continue using the old machine, I need to incur a maintenance amount of 10,000 rupees, which has been like provided me in the question itself. So what's gonna be my present value of the cost of machine if in case I'll be replacing the same after a year? I will suffer with that opportunity cost of 40,000 rupees, plus I need to pay off that maintenance charges for 10,000 rupees. So I'll be multiplying the same with the present value interest rate factor for the next year, and out of the same I'll be recovering a salvage value of 25,000. Again, in the next year, I'll be multiplying the same with the present value interest factor of that particular year. So I'll get that I need to pay off, if I'll talk about the present value of the cost of machine, it will cost me a rupees 26,960 rupees. Okay, and since we all know that we are required to spend this amount only after a year, okay, so this is something which is my current value, my present value. Okay, my present value will be 26,960 rupees is going to be the cost of mine. Okay, I need to figure out what will be the cost of mine after a year. Okay, because I need to get the future value of it. So I'll be multiplying the same with 1.15. Okay, that is my opportunity cost of capital. I'll get a figure of rupees 31,000 over here. So what did we got from this analysis? Okay, this analysis has made us very much simpler with the kind of thinking, the kind of understanding, and that is we can simply replace the machine now itself. Guys, why do we waste time and pay off 31,000 okay next year, rather than we can simply go ahead with paying off 28,600 now, and we should not wait for the next year. Okay, in that particular case we'll have to spend 28,600 now, and again 31,000 next year accordingly. So technically that is very simple. we just need to replace the machine now and spend just 28,600 rather than spending 31,000 and 28,600 thereafter. So 28,600 is something which will be like common and static for the next years. Okay, why? Because my cost of machine is not going to be changing. My maintenance charges for that particular new machine is not going to be changing. Again, my 20,000 rupees as salvage value, again, that is something which is not going to be changing at all. So that will remain same for the next years. So why should I pay in the first year itself as 31,000? I will simply resort to replace the machine now itself. So this is something which has been like told upon with this particular question. I hope I was able to deliver you with a kind of perfect understanding how to go about and answer the questions in examination as well. So shall we proceed further, guys? Let's go ahead with the next question. So guys, this question was asked in CA final examination for May 2012. It says a machine used for on a production line must be replaced at least every 4 years. Okay, we need to consider this fact that we need to replace our machine after an interval of every 4 years down the line. Okay, the costs which are incurred to run that machine according to its age are as follows. Number one, what's gonna be my purchase price for that machine? It's gonna be 60,000 rupees. What about how about my maintenance? So I'll have to incur rupees 16,000 in year 1, 18,000 in year 2, 20,000 in year 3 and 20,000 in year 4 as far as my maintenance is concerned. Now coming to the repair part, I need to spend 0 bucks in year 1 on repair. If I talk about year 2, year 3 and year 4, I'll have to spend 4,000 rupees, 8,000 rupees and 16,000 rupees as far as my repair amount is concerned. And if in case I'll be like willing to sell out that machine, okay, how about the kind of benefit that I'll be like able to receive if I'll be like selling it as a scrap value? So the scrap value for that machine is gonna be at the year 1, it's gonna be 32,000, 24,000 in year 2, 16,000 in year 3 and in the 4th year, if I'll be like utilizing the machine for the entire 4-year period and I'll be like willing to sell out that machine after a period of 4 years, I'll be able to get rupees 8,000 from the market as its scrap value. Now, coming to the next point, it says future replacement will be with identical machine with same cost. So what's the kind of benefit which we have like received while reading this particular line? It simply says that if in case we are willing to replace our machine, so it's gonna be with the identical machine only with the same cost. So today, if I'll be like willing to purchase that machine at 60,000 rupees, even after a period of like 1 year, 2 years, 3 years down the line, that machine is going to be costing me the same amount, that is 60,000 during that particular year. Revenue is unaffected by the age of the machine. Okay, and you can ignore inflation, you can ignore taxes. We need to determine what should be the optimum replacement cycle. Present value factor for 15% rate are 0.8696, 0.7561, 0.6575 and lastly 0.5718. So what do we need to do in this particular question is we just need to provide them what should be our best kind of replacement cycle, when we should replace the machine so that we'll have to incur the minimum amount of costing. Okay, are we guys clear with the kind of question, the kind of thing which is being asked in CA final examination for May 2012? Perfect, guys. Let's move towards how we should proceed while doing and attempting this question in the examination. So let's understand what amount of cash inflows and cash outflows will be like involved in this complete process. Guys, number one, let's talk about outflows first. What will be the amount that will be like spent from my pocket in order to go ahead with this decision? In the year 0, I'll be purchasing the machine. Okay, that is gonna cost me of 60,000 rupees. So if you can see the age of machine and under the same outflows has been provided. So at the year 0, it's gonna be 60,000 rupees negative. Okay, that is my first outflow, my purchase price. Coming to the second year, okay, that is first year actually. So first year's outflow will be none other than the maintenance part. Okay, only maintenance. Remember, repair amount was 0. So the maintenance amount was 16,000 rupees. So my maintenance is gonna cost me up 16,000 rupees with 0 amount for repair. So my overall outflow in the year 1, it's gonna be 16,000 rupees. As far as my year 2 is concerned, my maintenance amount was 18,000 rupees and my repair amount was 4,000 rupees. So both of them are my outflows. So I need to add both of them to my outflows. So it's going to be 18,000 plus 4,000, that is 22,000 as my outflow for second year. If I'll talk about the third year, my maintenance amount was 20,000 rupees and my repair amount was 8,000 rupees. So it's going to be added up. My total outflow will remain 28,000. And as far as the fourth year is concerned, my outflow is going to be 20,000 rupees as maintenance and 16,000 as my repair. Total 36,000 rupees as my outflow. This is something which was about only outflows. Coming to the inflows part, what amount will I get as inflow? That is none other than the scrap value. If I'm like willing to sell out that machine in that particular year, what's gonna be my inflow? Only that scrap value that I'll receive from the market. So the number one is year one scrap value, which was 32,000. Then for the second year, it was 24,000. Third year, if I'm like willing to sell it out in that third year and not in the first 2 years, I'll have to like get lesser amount as my scrap value. That's pretty obvious of the thing. So it's gonna be 16,000. And in the fourth year, if I'll defer this decision of scrapping it up for like till the last moment, I'll be able to receive just 8,000 rupees from the market. That is fourth year inflows. So how about my net inflow in the end of each and every respective year? Number one, for the year zero, it's gonna be 60,000 rupees. For the year one, it's gonna be 16,000 as positive. My scrap value is exceeding my total amount of outflows. So my overall benefit is 16,000 rupees. Now coming to the second year, it's gonna be 2,000 rupees. 24,000 as inflow minus 22,000 as outflow. It's gonna be net inflow of 2,000 rupees. Then in the year three, it's gonna be negative 12,000 rupees. Why? Because my outflow is 28,000 and my inflow is merely 16,000 as compared to that. So it's going to be overall 12,000 as negative inflow. Okay. And in the last year, it's going to be huge, which is outflow of 36,000 rupees and inflow is merely 8,000 rupees. So it's going to be net inflow of negative 28,000 at the end of year four. So this is something which is all about the net cash inflows and outflows. Now, we need to consider our decision whether we should replace at the end of year 1, year 2, year 3 or year 4. So let's go ahead with the next table which simply says in the year 1, okay, I'll talk about. So year 0, year 1, year 2, year 3, year 4. I have simply marked out all these things over here itself and in front of them I have provided the present value factor here itself so that you can guys get the clear idea how about my complete table is being made. So if I'll talk about the year 1, it's gonna be a cash outflow of 16,000 rupees, 60,000 rupees, 60. Okay, and again the same, I'll be able to get a net inflow of 16,000 which has been like provided in the above table as 32,000 minus 16,000 which is 16,000. So in the year 1, what all will be like added and subtracted from my table? 60,000 rupees is my cash outflow and I'll be able to receive a net inflow of 16,000, 1/6 over the same. Coming to the second part, okay, that will be what should be my year 2 basically replacement costing. Okay, year 2 will be like first number one, I'll be like procuring that machine for 60,000 rupees, 60,000 rupees. In year 0, it will be multiplied against the present value factor of 1 only. Okay, in the second year, I will be basically losing on to an opportunity cost of 16,000 if you can simply get that. Okay, year 1, I was supposed to get a net inflow of 16,000. If I'll be deferring my decision to next year, I should simply say that I'll be basically going ahead with an opportunity cost of 16,000 if you can say. Absolutely right. So what if I would have got an option to procure and sell out that machine in the first year itself? I have got 16,000 in my pocket. But since I deferred that amount, I have basically went into an option for going ahead with the opportunity cost now. So that 16,000 in first year, which was positive, now that same 16,000 is going to be negative. Why? Because I lost that opportunity of selling that machine in the first year itself. So this is again my costing. Okay. So I'll be adding this in my replacement costing. So 60,000 rupees is my purchase cost. 16,000 for first year is going to be my opportunity cost for second year, for third year, for fourth year, for all the years. If you can see over here itself. So 16,000 positive in year 1, 16,000 negative in year 2, 16,000 negative in year 3, and 16,000 negative in year 4 as well. Now, coming to the second year's best perspective, which is we'll be selling out that machine for 2,000 rupees net inflow, okay, which has been like showed in the above table. So I'll be adding that particular amount in year 2 against 0.7561, that is the present value factor of that date, okay. Now, this is all about year 2. Coming to the third year, I'll be incurring a cost of 60,000 rupees, which has been like told the purchase price. I'll be having an opportunity cost of first year, which is 16,000 rupees. I'll be having an opportunity cost of second year also. Okay, why? Because I have deferred the decision of replacing the machine till third year. So I have to go ahead with 22,000 rupees as well, which was my cash outflow of that first year. I need to uh, pay that cash outflow. Okay, that's to be spent in year 2. So I'll be adding that amount here itself. Plus, I'll also be adding the net inflow, which is will be received in the end of year 3, which is negative over here, which is 12,000 rupees negative. I'll be adding that here itself, okay, as a negative term. Coming to the fourth year, that is the last year, what will be included in my overall costing? First, 60,000 rupees as first year's purchase price, then 16,000 rupees as the outflow for first year, then 22,000 which has been the outflow for second year, then 28,000 which is the third year's outflow which has been provided. I need to spend all these outflows. Why? Because I'm deferring my decision of selling the machine till the fourth year now. And what will be my fourth year's net inflow? That will be negative 28,000. I'll have to incur 36,000. In comparison to that, I'll be receiving 8,000 from the market as scrap value. So the overall net inflow will be negative 28,000. So how about my net present value? If I'll talk about the present value of all the inflows minus all the outflows, I'll get my net present value for year 1 as 46,086 rupees as my year 1. Why? Because I need to multiply 16,000 which has been like provided in year 1 with the present value index of that year, which is 0.8696. So I'll be getting a net present value accordingly as 46,086 rupees. For the same reasons, I'll get the replacement cost NPV of second year as 72,401, 98,438 rupees for third year, and 1,24,968 for fourth year. Okay. Now, coming to the best perspective, which is my cumulative present value interest rate factor. Now, this is the costing for all the years. Okay. If I talk about the costing, which has been like net present value, which has been mentioned over here as 1,24,968. This is not just the costing for 1 year. Okay. I have added back all the outflows for year 1, year 2, year 3, all of them with fourth year as well. So I can simply say that it will be like very harsh, very not basically harsh, it will be incorrect. It would be inaccurate if I'll be like directly multiplying them with the respective years uh, present value interest rate factor, directly dividing them up basically. So it's always prudent and it's always accurate to add all these present value interest rate factors, because why? The complete costing is moving ahead, which is year to date kind of stuff. Okay, so the cumulative present value interest rate factor for year 1 is 0.8696. I'll be adding it with 0.7561 to it. Okay, for the next year, it will be 1.6257. Then again, I'll be adding 0.6575 to it. I'll get 2.2832. And again, I'll be adding 0.5718 to it. I'll get 2.8550 to it. I'll be technically dividing this particular cumulative present value interest rate factor with the net present value. I'll get the ENPV, that is the equated net present value, as 52,997 for year 1, 44,536 for year 2, 43,114 for year 3, and 43,772 for year 4. So guys, which one is the best decision? It's absolutely prudent and it's absolutely clear over here. Go with the third year. Why? Because it's gonna cost you the minimum in that particular case. So this was the question which was asked in CA final examination for May 2012. Remember guys, capital budgeting is not so easy of a kind of a topic. Only and only if in case you can get the concepts clear. Okay, if you can get the proper understanding with kind of concepts, the kind of basics which are being told to you guys, that will be very easy for you guys to crack in this particular subject. as well in this particular chapter if I'll talk about. So with this presentation stands concluded. I hope you guys got the complete understanding with whatever kind of questions that I made you understand over here itself. And I'll see you in the next presentation with a lot more questions there also. Many more questions are waiting for you guys to encounter. So don't you worry about the same. I'll make you head start with that. Go ahead. With this, I'll say thank you on behalf of the Edupedia world. Keep interacting, guys, with the questions, queries, and YouTube comment boxes. I will love to answer each one of your queries and responses. If in case you have liked our video, if in case you find it informative, if in case you've got the kind of concepts which I'm likely to tell you up over here, do give us a thumbs up, do give us positive comments so that we can get the positive booster in ourselves as well. Stay connected, guys. That will help us in understanding your needs way better, guys. I'll see you in the next presentation with a lot more exciting questions. Till then, sayonara. God bless you all. Take care. Bye.